So turf war, we're going to see if anyone admits it's a war, but before we get to that, we have an all-star panel to talk about this on the stage today. We are lucky enough to have Brian Quintenz here. Fairly recently left his role as CFTC commissioner and jumped with both feet into crypto, now working as head of policy at A16Z Crypto. And next time we have Dan Berkowitz, has been general counsel at both of the agencies we're going to be talking about today, and also a commissioner at the CFTC. It's kind of a one-man panel, really. And finally, we have Ryan Van Grack, oversaw the SEC's work on crypto in the sort of pre-Gensler era and was senior advisor to previous chair Mary Jo White at the SEC. Now the general counsel for the Americas at Citadel Securities. So talk about a timely issue. The who and how of oversight for years has been sort of the central question for crypto in the U.S., but it's become more lively recently, obviously, as we'll discuss. So I'm going to hazard a guess that there might be some pushback on just the perception of a turf war. But before we get to that, I'd like to survey the crowd here, if we can get a little participation. If I could, by applause, between the agencies, the Securities and Exchange Commission and the Commodity Futures Trading Commission, who is hoping the SEC develops into the dominant regulator for U.S. crypto? Applause? I don't hear any. What's going on? Now, who would rather see the CFTC in that capacity? So that's been pretty consistent, I think, but I do wonder if it's shifted away from CFTC, just the enthusiasm just a little bit, as we've seen some pretty major enforcement action lately from that agency. But of course the answer is it's going to be both. Both of these agencies will have a major role in overseeing crypto, and while they might insist sort of loudly that they're working beautifully together in glorious harmony, we've seen some practical signs that they're at least in some degree, in disagreement or at least uncertainty on who should be minding the crypto store. So, our first question for you guys. What do you really think is going on? And I'll let everybody answer in turn here if we want to go down the row.
What's really going on?
Yeah. As the agencies try to figure out, who should be doing what to whom, and what's happening here.
Well, okay, I'll take a stab at that. I mean, I think what's really going on is the agencies using the laws that they've been given in their own ways under the perspectives and motivations of their own chairs to address this space. The CFTC does not have jurisdiction over commodities. The SEC has wide latitude over the securities markets. And we've seen the chair of the SEC take the view that all crypto, except for Bitcoin, are in his jurisdiction and need to follow their rules. And I think to the title of the panel about whether or not there's a turf war, I mean, I think, a war involves two sides. And right now, I think there's one side that's on the field that's running down to the other end and spiking the football, because the CFTC does not have a seat at that table. And in order for the CFTC or any other regulator to have a legitimate view of their jurisdiction that could challenge the SEC's perspective on what is and is not a security, and maybe force some more clarity other than the videos that we are seeing posted on the SEC chairman's Twitter feed, which talk about goldfish and dogs. You need to have a new law that's passed by Congress that addresses what these products actually are and has a regulatory regime that is fit for purpose, that doesn't kill their technology like the securities laws do. So that's a quick overview from my perspective.
Dan, I'm guessing you might have an alternative take on this.
I served with Brian on the CFTC, and Brian and I are very good friends, and sometimes we agree and sometimes we have different views. My view is what's happening right now is each agency is implementing the statutes as directed by Congress. CFTC is regulating commodity derivatives markets, and I think one way to think about or to get some clarity in the public mind, people think of commodities. CFTC regulates commodities, the SEC regulates securities. The CFTC doesn't actually regulate commodities. Look at the name of the agency. It's the Commodity Futures Trading Commission. The CFTC regulates the trading of commodity futures. So what's in the CFTC's regulatory jurisdiction is commodity futures, not commodities trading, it's commodity futures trading. So, well, what's a commodity under the Commodity Exchange Act? It's a somewhat circular thing. A commodity under the Commodity Exchange Act is something that's the subject of a futures contract. So the key question for the CFTC's regulatory jurisdiction is it a futures contract? Just because it's a commodity, it doesn't really get you very far. Things can be commodities and securities. As a matter of fact, most securities, if not all securities, are commodities. Why is that? Because you can put a futures contract on a security, okay? And putting a futures contract on a security makes it a commodity. If you put a futures contract on a security, you have security futures, and both agencies have jurisdiction. But if it's not, the first question you have to ask is it a security? If it's a security, it goes to the SEC. If it's a futures contract or a derivatives, it's not just, now we've got swaps, we've got options, things like that. Then it goes to the CFTC, and that's clear. And there's been no dispute about that jurisdictional division since those statutes were enacted and amended in Dodd-Frank. So, and I don't think either there's comments about what the respective chairs have said. Chairs of CFTC and the CFTC has made declarations. Ether's a commodity, Bitcoin's a commodity, Litecoin's a commodity. That's been true for many, many years, since at least 2017, at least, when you had futures contracts on Bitcoin and Ether. That makes them commodities. That has been upheld. So that crypto assets are commodities is well-established law, and if you put derivatives on them, the CFTC has jurisdiction, such as in the Binance case. The Binance case involved derivatives on those commodities, and that's why the CFTC had jurisdiction on that. The SEC, in my view, is applying the securities laws as it sees. There's the Howey test, what's a security, and the chair has stated his view that many of the digital assets are securities, and that's his view, but ultimately it's up to the Securities Exchange Commission, the commission as a whole, to make the determination of what's a security. The other point that I'd like to address is the jurisdiction of the agencies, the commodity futures and the derivatives markets are price discovery and risk management markets. That is the function of the derivatives markets. The function of the security markets is capital formation. The SEC and the Howey test is basically the capital formation test. If you're raising capital, if you're trying to get other people's money for investments and put it to investment use, that makes it a security. And that's the essence of what Howey is getting at. So that capital formation is the SEC's jurisdiction. It doesn't make sense to give a capital formation issue to the CFTC. That's not what they do. So my view is, if it's a security, it has to stay with the SEC, no matter what technology is used to develop that instrument. The SEC has been saying that we are technology neutral. If you raise capital, whatever technology, whether it's digital, whether it's through a blockchain, or it's through a piece of paper, or through a telephone call, it's SEC's jurisdiction. And I think that's going to stay the way it is, because that protects the whole capital markets. If you had a different regulatory regime based on the technology of how you raise capital, you'd have a whole bunch of game playing going on in terms of how to raise capital.
What do you think, Ryan?
Yeah, so thanks for having me here. It's great to be on a panel with two distinguished former regulators, both of whom have most recently been at different commissions, so I'm going to be maybe the honest broker between the two. I'll take a step back. First of all, I think when you I think it's not an either or. And when you conceptualize jurisdiction in that framework, I think it's counterproductive. Because if you take a step back, the Dow report that was issued by the SEC that first kind of labeled certain digital assets securities was issued nearly 6 years ago. I should know, I was there, I helped work on the report. Since then, you've had dozens, if not maybe hundreds, of enforcement actions and speeches and conversations. But here we are 6 years later, and the conversation hasn't been materially advanced. And I think as long as we're fixated on a zero-sum game where someone is supposed to champion one agency over another, I think it distracts from where efforts should be channeled. In particular, and I think both Brian and Dan alluded to it, there are some potential gaps in the marketplace when you talk about non-security tokens. And it doesn't mean that one has jurisdiction over the other. What it means is when something is a non-security token, the Commodities Futures Trading Commission does not have the full suite of regulations to deal with spot Bitcoin or spot Ether, for example. Focusing on those gaps seem critical because while we are mired in this turf war debate, you have millions of retail investors who are trading, for example, spot Bitcoin without the full suite of federal regulatory oversight. At the same time, we have to accept that their jurisdictions are not mutually exclusive. As Dan notes, there are regimes where there's joint jurisdiction. That is an accepted part of the regulatory structure where we have an agency. It's unique, somewhat unique in the US. You have an agency responsible for securities oversight and an agency responsible for commodity derivatives. That has been the case for decades. The question is, we've learned to function in that universe with other asset classes and products. Why is it so challenging to try to break it down and focus on how to do it in this context? And until we take a step back and stop conceptualizing this discussion as favoring one commission over another, the moment we can move past that, we can drill down on a regime that focuses on transparency and clarity, that provides robust investor protections. I think ideals that both the SEC, the CFTC, the crypto industry writ large would support. I think if we channel our efforts there, I think we're likely to not be in a situation where 6 years from now, we're still debating whether a particular coin is best suited to be hosted by one agency over another.
So the SEC has taken the position under Chair Gary Gensler that no new rules are needed to get a handle on crypto. Obviously, as we all know, he advises firms to come in and talk, come in and register. And some have taken him up on it, and so far there seems to be a pretty maybe zero level of success for that. So, Ryan, let me ask you, should his agency actually be writing tailored rules for crypto? What do you think?
Yeah, so when I think of the current landscape of regulation, there's a lack of clarity. I think that's fair. I think there are two sides of that coin. On the one hand, with the pace of innovation and technology, it's challenging for any regulator, both domestically or abroad, to keep pace and identify the right parameters. And because of that, I think you potentially have a lack of investor confidence. You potentially have maybe more traditional firms more reluctant to engage because with regulatory uncertainty becomes regulatory risk. On the flip side, there is a benefit to regulators having flexibility and not fully clarifying with precision where the line should be drawn. That's because they want the flexibility should there be additional technological developments. They don't want to be boxed into a position. And they have to be mindful of gamesmanship and whether market participants tailor the rhetoric or the structure of what they do to fall just outside of the purview of a regulator. And that's a legitimate, I think, ongoing concern. I guess the one thing I would flag is in the absence of that regulatory clarity, what you have primarily is an enforcement kind of based regime. And enforcement is a critical part of any regulatory structure. It is absolutely foundational. I worked on it when I was at the SEC. It is critical to identifying, halting, and punishing bad actors. But it's not a panacea. It is a sufficient, or is a necessary, but not sufficient part of a regulatory regime. And enforcement alone has shortcomings. because temporally, enforcement matters come after the fact, after bad actors have violated a rule, and so there's necessary harm that comes with it. There's a resource constraint. Enforcement divisions are not meant, don't have the ability to go after every bad actor, so necessarily you're having to triage which matters you bring and which ones you don't. And there's an informational infirmity with an enforcement-based regime because enforcement actions are not nuanced. They're fairly blunt instruments, and they tend to go after fact patterns and legal issues that are more obvious in nature, and you shy away from more difficult issues that require clarity. And so I think when you only focus on enforcement, I think you end up kind of falling well short of what you need to establish a robust regulatory regime.
So clearly answering what makes one token a security and one a commodity to some degree is sort of not entirely in the hands of the regulators. We're sort of waiting on Congress. We're seeing cases work their way through the courts. Dan, how do you think this is going to end up? Crystal ball it for us.
Well, in any given case, what the SEC determines as security, for example, in any given case, in any given enforcement case, ultimately there's judicial review on an enforcement matter, and the court will determine whether they will either uphold or not uphold what the agency does. Fundamentally, though, I don't believe that process, whether in this case or in that case, or frankly through congressional legislation, that the basic Howey test will be changed. And for many of the reasons Ryan was talking about, the Howey test, what's a security, is a facts and circumstances test. It's worked for 1946, so it's worked for nearly 80 years. For you lawyers, you go on LexisNexis or Westlaw and you look it up and all the citations. There's 10,000 citations to Howey. The whole our whole system over the 80 years is built on Howey, and it's a facts and circumstances test. The facts and circumstances test doesn't mean there's a lack of clarity. It means you might not be, there's not a bright line. Somebody can't just say, oh, it's clearly on this side of the line or that line. You're going to have to evaluate facts and circumstances. You might have to pay lawyers, and lawyers might have to give an opinion, well, on the one hand, on the other hand, but predominantly, I mean, that's law. I mean, that's how businesses operate. Howey is not the only facts and circumstances test in American law. So I think at the end of the day, regardless of what happens in any particular enforcement case, Howey will be the law, and the SEC jurisdiction, for the reasons I talked about, will probably be unchanged in terms, because the at risk here is capital formation process, investor protection, the whole integrity of the process. What I think has to happen is to go to the next stage. Okay, if it's a security, many of the securities laws and many of those SEC regulations were developed with corporate issuers in mind. They weren't developed with this technology in mind. So what has to happen is this process that had started, and then FTX came along and the mode changed more to enforcement than discussion. It has to get back to that to go forward, because people have to come in and say, here's how I propose to satisfy the disclosure requirements, for example. We have to get to an acceptable disclosure regime where people can disclose if it's a security. But the fact that there's issues with disclosing doesn't mean it's not a security. The discussion has to go on as to how to meet the disclosure requirements. The agency can address it in two ways. People can come in and get individualized relief. What the agency does is no action letters saying we won't enforce if you do it this way. They could get exemptive relief, or they could do a broad rulemaking. And some of the, Ryan has talked about, and some of the previous panelists talked about, to do a rulemaking, you're laying down the rules for the future. You do want to build in flexibility. And look at what's going on here. All the new technologies, all the development, what's happening this year might be different next year. And if we start a rulemaking now, what's the situation going to be like a year later? So perhaps the case-by-case approach, where you give individualized relief, people come in one by one, you get no action relief, and then after a number of years, you say, okay, we see how this is developing. You got relief, I'll do it that way, or what if I want to do it this way, will you give me relief? And you build up a record, and the agency gets experience, and then after a number of years, you codify it and put a regulation, say, we have confidence in this method of going forward. So those are the ways to go forward.
Brian, do you have thoughts on this?
Yeah, I mean, I think I genuinely agree with the end point that Dan was saying, and I think that that's a process that in some circumstances has worked very well, and we had seen that at the CFTC, I think for different reasons, but likely, ultimately with successful outcomes that both he and I worked very hard on to try to codify exemptions, for rules that were written very quickly and maybe not very carefully in response to the financial crisis. I think that takes a willing regulator. It takes a willing regulator to have those conversations and understand those differences and being able to accommodate how those things don't fit. And I mean, when you think to the Howey test, as it is 4 high-level principles, right, that are meant to be applied on a facts and circumstances basis. But that is not what is happening. They're being applied on an entire industry, without clarity. And when they are being applied specifically in court cases, they're being applied to very weak defendants, usually who are either have left the country or are being criminally prosecuted and don't have the resources or the incentive to actually pursue, an outcome in the legal system, which means that you're going to have settlements that agree with that perspective from the agency that isn't necessarily addressing the facts and circumstances of those underlying products. And as I think about what's changed over the last 80 years since the securities laws came online and since the Howey case went through the Supreme Court, I mean, for the first time, we have the ability to create unique digital items that have composability, that can have use cases, that can be transferred peer-to-peer in a trustless fashion without intermediaries for the first time in 200,000 years. I mean, to me, that's a pretty big deal. And we should make sure that if a regulatory regime is being applied to that it respects the weight and breadth of that innovation. And right now, that's not what we're seeing.
So let's drill down a little bit on one particular instance. So Ether has become a kind of a test case. Gary Gensler said, especially after its move to proof of stake, that it's likely a security, or at least suggested this. CFTC just declared again in the Binance enforcement action that it fits more in the commodity space. So granting that something can fit in both buckets, does one side have more of a case? Does anyone have thoughts on this?
Well, I'll say what I believe is the law as it exists today. And to Dan's point before, that these things could be both, but once they are determined to be a security, they are carved out of the CFTC's purview, right? So the status of ETH as a commodity will not change whether or not it is deemed also to be a security. But if ETH is a security, then the futures contracts that are trading right now on the CME by institutional investors are illegal, and they are violating the law. So either the SEC is not being forthright about what the law is, or they're refusing to enforce that view. So in my view, absent either of those two things, in an enforcement case that shows that distinction, that is an invalid view by the chair or anyone else that's saying it, and ETH is a non-security commodity that is not in the SEC's jurisdiction.
Either of you guys have a thought? Ryan?
Well, Ether is a commodity, has been since 2017, and there's a futures contract on it. And until the Securities Exchange Commission, until the Securities Exchange Commission were to say that Ether or something else is a security, it's legal to trade it on the CME. I don't think there's any legal uncertainty about the current trading of the futures contract on the CME. So what may develop in the future, what the SEC may do in the future, we'll just have to see.
Right. What I would say is, I think it's important to focus on the now, which is until the SEC definitively weighs in, it's a commodity. The CFTC and Russ Benham, the chair, has been very clear about that, as have others. I think what's important to focus on is not just the futures contracts, but spot Ether does not have the full regulatory oversight. That's because CFTC does not have a jurisdiction outside of anti-fraud and anti-manipulation authority to regulate the spot market. Right? And there have been efforts like the Bozeman-Stabenow bill to address that gap, but to analogize it, the CFTC has the ability to put out a fire, but not to create the code to make sure that the building itself doesn't catch on fire. And that's a bit of an oversimplification, but I think while we're debating whether the SEC is going to step in, I do think there are some gaps that are important.
And I just want to be clear, too, in terms of that point, in terms of the non-security commodities, such as Bitcoin, where there is CFTC anti-manipulation and anti-fraud authority, but not regulatory authority. Again, Commodity Futures Trading Commission, they don't regulate commodity trading. They regulate futures trading, but they do have anti-manipulation authority over pure commodities that are not securities. There's no, I think the SEC, that's not something that really belongs in the SEC. That should be, in my view, a CFTC. Because it's not a security. So if Congress wants and give the CFTC jurisdiction over that, I think that would be beneficial to the market to have that at the CFTC.
So I think I may have time for just one more. So let's when you look at the leading crypto platforms that are still operating in the wake of the FTX disaster, so these two agencies are either actively hammering away at them or are about to. And this does seem to be sort of that, I don't know, maybe a term, next level enforcement that everyone's been waiting for. If, as the industry would have it, compliance isn't possible by coming into the SEC, for instance, but that is what's required to sort of maintain a connection to U.S. finance. What happens, I guess, when the unstoppable force meets the immovable object here? Does crypto have a way forward in the U.S.?
Well, in my view, it has to be solved legislatively. Again, without a willing regulator to accommodate the technology and write rules that fit the technology and protect consumers in the appropriate way, Congress has to step in. Whether they'll be able to finalize something as a law, I think we'll have to wait and see. I think the House Financial Services Committee and the House Agriculture Committee, the two committees that have jurisdiction over the SEC and the CFTC, are working very closely and cooperating for the first time that I can remember on possibly joint regulatory oversight in a way that actually does meet those objectives. How far that bill goes, we'll see. But I think that they've just had hearings yesterday. They're going to have more hearings next month, and maybe they'll get a bill on the floor and pass through the House, which I think would be a pretty big statement that Congress does not consider the current landscape clear and needs their decision-making to clarify.
I don't think the legislative solution is going to solve this problem. The securities laws, and it's not just this administration, the Dow report, the Telegram case, the Kik case, those are all brought by the previous administration. The agency's position has been consistent across administrations under the last two presidents, the current and the prior one. If you're security, you have to come in and register, and if you're trading as an exchange, you have to broker-dealer, clearing agency, and exchange registration. That's been across both administrations, so this isn't a partisan thing or the current administration only. What has to go forward is both the industry and the agency sitting down and working out how this technology and these types of instruments that are securities, if they are a security, to meet the standards of the securities laws, what the previous panel was talking about, investor protection, market integrity, et cetera.
What I would say is, I think we're almost at the exact one-year anniversary when the SEC announced that it was ramping up their crypto enforcement efforts, and I think maybe more than doubling the team there. And usually it takes about a year for a case to get investigated and come to fruition. So I think it is very fair to assume that we are potentially going to be seeing an additional wave of enforcement actions. Both the SEC and then the CFTC just announced a new head of enforcement, very capable former prosecutor. So I think we've started to see it now. I think it's reasonable to expect there to be more meaningful enforcement actions that come forward. I think going back to the point Brian was making, on the other hand, I think legislation would be a key solution to provide that clarity, but it does not seem, at least from my vantage point, that we are close to something to be able to make its way through the Senate and the House for a variety of reasons. I think politically, there's some tensions in the crypto space in terms of where the two parties stand. I think there's also discrepancies between some of the committees of jurisdiction about where to draw the lines. It doesn't seem like anything is materializing in the near future. And to put a political spin on it, you've got debt ceiling debate, you've got a presidential election. So I don't think there's a lot of oxygen in the air to resolve this legislatively, absent some compelling efforts either behind the scene or, unfortunately, maybe an event that catalyzes or incentivizes people to prioritize this over other issues. So I think in the near term, 2023, for now, is likely to be an enforcement-based kind of narrative in terms of the guidance and the headlines between both regulators.
You couldn't leave us with a note of hope as we make our way off the stage. We could have obviously talked for another couple hours about this. This is fascinating stuff. And please thank our panel today.
Thanks, Jessica.
Thanks, Dan. Thank you, Brian.